What do new beneficiary rules mean for your retirement IRA? Imagine planning your future and knowing exactly how your assets will pass on to your loved ones. Changes in beneficiary rules can make that planning more important than ever. These updates are designed to clarify and sometimes limit how your heirs can access your retirement savings. If you have a retirement account, like an individual retirement account, understanding these new rules is key to protecting your legacy. The biggest change is the end of the stretch IRA. Before 2020, beneficiaries could take distributions over their entire lifetime, letting the account grow tax-deferred for decades. This was a great way to pass wealth gradually and reduce taxes. Now, most non-spouse beneficiaries must empty the inherited IRA within 10 years of your death. This means they have a shorter window to take distributions, which could lead to higher taxes in a shorter time. For beneficiaries who are not your spouse, the 10-year rule is strict. They must fully withdraw the account balance within 10 years. This applies to adult children, grandchildren, and other family members who are not eligible designated beneficiaries. Starting in 2025, they will also need to take annual required minimum distributions each year based on IRS life expectancy tables. If they miss these annual payments, penalties of up to 25% of the missed amount can be applied. Eligible designated beneficiaries are a different story. These include your surviving spouse, children under age 21, those who are disabled or chronically ill, and beneficiaries who are no more than 10 years younger than you. These groups can still stretch distributions over their lifetime, giving them more flexibility. For example, a spouse can treat the inherited IRA as their own, continue deferring taxes, and take RMDs based on their age. So what does this mean for your retirement planning? If you want your heirs to have more control and flexibility, naming your spouse as the primary beneficiary makes sense. If you have young children, you might plan for their distributions to support their education or early adult years. For adult children, you may want to consider other assets or strategies to reduce their tax burden. Starting in 2025, your beneficiaries will need to take annual RMDs from inherited IRAs under the 10-year rule. They must calculate and withdraw specific amounts each year based on their age and the account value. If you had already started RMDs before passing away, those payments will continue. If not, they will need to begin in 2025, following the IRS rules. The IRS is now actively enforcing these rules. If your beneficiaries do not take their required minimum distributions, they could face penalties. While the penalty for missing RMDs was waived in 2024, the obligation to take the distributions remains. This makes it even more important to review your beneficiary designations regularly. Thinking ahead, you might want to consider strategies like taking larger distributions during your lifetime to reduce the size of your IRA. This can lessen the tax impact on your heirs. Or, you could explore charitable giving options to reduce estate taxes and leave a legacy aligned with your values. Understanding these new beneficiary rules helps you make smarter choices about your estate. It allows you to plan your retirement savings in a way that benefits your loved ones and aligns with your legacy goals. Staying informed means your wishes are clear, and your family can manage your estate smoothly when the time comes.